Good day, everyone. Today, as usual, as every week on Wednesday, we have new podcast. Mahendra Singh from Primerica and me, Alex from EXP Real Estate. And today we'll be tackling another very important topic, a topic that I'm pretty sure people will be very curious to listen about. And Mahendra will share his best practices, case scenarios, solutions, and definitely some recommendations. So, Mahendra, how are you doing today?
Doing excellent, Alex.
Great,
And
I
you?
am happy. I am excellent as well, and I'm eager to hear what you can share with our audience. I'm pretty sure it will be very helpful. So, audience and
Absolutely.
stage is yours, Mahendra. Let's go.
Thank you. Thank you, Alex. And welcome everyone to another Wednesday podcast. It's always a pleasure to share some vital information on financial literacy, especially in the area of insurance. That's my specialty in business. And today we're going to look at universal life insurance, which is
Oh,
one of the
nice.
most, Alex, has been one of the most popular products, I think, in the last 10 years, right?
Yes, I
And
know.
you'll see why during my presentation. And this is a type of product I would say that there are clients out there that are looking for a product where they can actually have insurance protection and they can also invest. This
I
is
see.
targeting that market of clients, most preferably families out there that have obligations that are looking to maximize the returns on their investments, but at the same time have adequate amount of protection. So what I'm going to cover is pros and cons and show you where this may fit that need or may not fit that need and what's the alternate choice. In for this presentation today, I have a client example where universal life policy was in place and we were able to make some changes for her and her family and provide better value, right? So I'll be sharing with that
Great.
very soon.
So
So
just to recap, that product is actually for everyone who is feeling comfortable to go for that product. Doesn't matter it's first-time home buyer, second-floor buyer, investor, whoever is looking for kind of insurance that you have uh, insurance coverage portion and investment coverage portion seems to be
yes.
like a very good product for them, right?
Right. It seems to fit the needs of certain people who are looking at, they may have different goals, right? For someone who is looking primarily at a product where you can actually maximize your returns on
Yes.
investments, it may not be the best product for that particular individual. If you're an investor and you're
Mm-hmm.
looking to make money, I think the best way to make money is in real estate and in the markets, in the stock market, right?
I see.
However, people find, that certain insurance policies, you can actually have an investment component. And
Yes.
I just want to break that down today and show folks how that works, okay?
Great. Let's see.
So, so we'll get going with that right away. I'll actually share my screen here.
Mm-hmm.
So it gives I always believe in pictures. Pictures give 1,000 words, okay?
Absolutely. I agree with you.
And as usual, Alex, I always start out my presentations with the basic fundamental of why are so many people struggling? And we covered this in our last podcast, is
Yes.
most people don't have the financial education. Don't you think
Mm-hmm.
so? Most people,
100% sure.
right?
Absolutely. Wherever we are and talking with the people, doesn't matter in Canada or anywhere
Right.
else, we are on same ground that we are not knowledgeable at all in that field.
Absolutely, absolutely. And there's no courses that actually educate people on personal finance unless you go pay for one, right?
Absolutely.
And last podcast we touched on the financial game plan. So in this presentation today, we wouldn't look at the theory. I'll show you the actual example of a client where we put this game plan to work, okay? And
Excellent.
we're going to be able to build them a significant amount of wealth. Um, and also, as usual, the coaching. I've been in this business 11 years, and I could tell you the coaching is something that I benefited from the most.
I
Okay.
agree.
Coaching with my own personal finance and coaching in business, right? So that is absolutely amazing. And our mission, when we talk about our target market, here's my mission. My mission is to help people. My mission is to help protect families, help people to get out of debt sooner, and create wealth, build them some financial independence, right? And I
Absolutely.
think that's the goal of our company as a whole, right? But we have over 130,000 licensed representatives. Imagine we sit, over thousands of kitchen table presentations on a weekly basis. It's just pretty impactful. Now,
Absolutely.
main question I have for people, guys, if you're listening in and you now realize that this product sounds interesting, I have a question for you. Do you think you have the right type of life insurance protection for your family? See, every family, Alex, would you agree with me? Every family has different dynamics, whether it's a family structure, financial structure, right? We
Absolutely.
absolutely right. So I believe in tailor-made solutions. I don't believe one product fits all the needs of a family. I believe in tailor-made solutions and customizing a plan for that family, right?
I agree.
So just to cover the basic fundamental here about universal life, I think instead of typing a paragraph, let's draw a picture.
Yeah, I agree.
And what you're looking at there is you see a bucket and you see a bunch of stuff coming in and going out. So what is this about? The way a universal life policy works is this. Number one, the client puts a certain amount of premium into
Mm-hmm.
their policy,
Yes.
right? Which is generally managed by an insurance company. Okay. The second thing that happens is obviously every company has sales expenses, premium tax, they have other overheads, admin overheads, etc. So what happens is if you put $200 a month, for example, in this product, let us say $80 come out for expenses, right? It leaves $120 to cover the insurance costs and cover any savings that you want to build in this policy, right?
Mm-hmm.
So the $120 may go towards providing say $500,000 of protection in this, for example, and then they may have a little bit of money left. You see at the bottom it says number 4, segregated portfolio. There may be a little bit of money that's going to trickle into that bucket. We call it an accumulation fund, where you can actually pull money out from time to time. I mean,
Mm-hmm.
keeping in mind there might be fees, there might be different costs associated with surrendering that. Okay.
I see.
So this type of policy for the market out there is satisfy the needs for one, giving you protection, and two, giving and satisfying that investment need that you have for your family. Am I clear so far?
Yes, yes. Two in one.
Two in one, right? It's a two-in-one combo, let's call it.
Yes,
All
yes.
right. All right. Now, I want to share this. This is a third-party article from the Wall Street Journal, right? And you could take a picture of this. The universal life insurance was a 1980 sensation when interest rates were very high. So these type of policies came out because they could actually make you a lot of money on the investment component back then when interest rates were like 18%. GICs could have made you 18, 16, 17% back then, right? That was a good
Mm-hmm.
investment back in the day. But look what happened. A long decline in interest rates caused premiums to soar when they were
I see.
supposed to stay level.
Mm-hmm.
And as the article states, lawsuits arose, and from the mid 90s to early 2000s, interest rates start simmering down, right? Um,
Yes.
what happened, right? Lawyers reached settlements over allegedly deceptive sales practices. So this is something, when it comes from an education standpoint, I think people need to be more aware of the type of product you should own, the type of product you should stay away from. Okay. And you can
And
check this
market
out.
reality at the time, right? Because as you
Yes.
mentioned, in the 80s, when market was totally different with the mortgage rates, it was maybe profitable and very appealing and attractive.
Yes.
But with the lower mortgage rates, definitely your yields on these kind of investments will be less, and you should show flexibility and appropriate mindset to switch to product that suits your needs at that given point of time.
Right. Right. Yeah.
I
That's
see.
right. That's right. Right. So absolutely. So this is a book that I came across. It explains, what happens in a universal life policy. So it's very, very useful material out there. It kind of breaks down how it actually works, right? I'm not going to cover the great detail of this book. I just want to switch right away to our client scenario. My
Mm-hmm.
client, my client was not a homeowner, young person, age 27. Okay, she happened to purchase a universal life policy at the time. It was costing her $300 a month. I'm just putting a little check mark here so
Mm-hmm.
everyone can see. It was costing her $300 per month. Okay.
Will you be sharing some screen with us, Mahendra?
Um, Actually, I thought I was sharing. Sorry.
Mm-mm.
Okay. Sorry about that. I thought I was sharing, Alex. I'm
Mm-hmm.
so sorry.
No worries.
Okay. Okay, 1 second. And so you didn't see anything all this time?
No.
Okay, that's fine. I'll show the picture. Sorry, guys. I'll show the picture.
Yes.
So here's a picture. Um, I thought you were seeing it, so my apology. So here's a picture where you have a client paying the premiums and everything else that I explained, all the expenses that come out of this policy, and it
Mm-hmm.
leaves an accumulation fund in that policy, which you can actually take out at some point in time. So that's the picture right there. But
Mm-hmm.
let's get right into the client scenario. You can see this one, right?
Mm-hmm.
Okay, good. So young family, 27 years old, non-smoker, paying $300 per month. I'm highlighting that. So
Mm-hmm.
right here, $300 a month. Policy was issued back in 2018, so not
Mm-hmm.
too long ago. Um, Now, what I realized was the agent did not actually complete a financial needs analysis for this client. So I had no idea how they determined the amount of insurance protection she needed, but she had $500,000,
I see.
right? So it's like I'm covering my home and I don't know the replacement cost of rebuilding my home. How do I know how much home insurance I should be buying? Is it 1 million? Is it 2 million liability?
Yeah.
Right?
Nobody knows. Yeah.
Right. So if the cost of rebuilding my home is a million and a half, and I'm only covered for 1 million, means I have a shortfall of $500,000 on my house insurance, right?
Yeah, but in this case, she was not homeowner, right? She had no liabilities of that sort.
She had no liabilities, absolutely,
Okay.
absolutely. So let's go to the next part. Here's when we start unraveling the policy and flipping the pages of the policy. Obviously, there's no name here, right? This is all
Mm-hmm.
confidential, but this is the structure of the premium. So from the year 2018 all the way, as you can see, there are increasing rates. So at age 64, the policy actually goes to $2,600, $2,671 a month. 10
Mm-hmm.
years later, you can see the increase there, right, Alex? It's
A
pretty
month. You're talking a month.
this is per year.
Okay. Okay.
Per year,
I
yeah.
understand.
So 10 years later, imagine this, you are retired, okay?
Mm-hmm.
Your old age security and your CPP is probably 18 to 20,000 in the year.
Mm-hmm.
But you have to come up with 11,000 to pay your insurance policy if you want to keep it.
So that is almost $1,000 a month at the age of 74, and you're almost 9 years in retirement, right?
That's right. That's right.
It will be
And
very difficult to meet ends in that case.
right. So what happens is with a lot of not only universal life policies, a lot of other type of policies out there, what I notice is people buy it because of the cost. They don't buy it because of the value it provides. And what happens is in the later years, you may have in the early years, the cost seems very low,
Mm-hmm.
but in the later years, you have very, very steep increases, right?
Mm-hmm.
I believe clients should know about that up front. Don't you believe so?
Of course,
Right?
I agree
You
with
know
you.
that front, right? Because here, this client, when they open their policy at 74, they see $11,261. And at 84, well, forget it, right? For the average
Of
person,
course.
right? And $21,000, right? So at that time, hopefully you don't have commitments like a mortgage and all that stuff. But who's going to find that kind of money at that age when you have fixed income during retirement? Okay.
Absolutely.
Um, yeah, I have a client, his mom just passed away, pretty wealthy guy. He used to pay $9,000 a month. When his mom was in her late 90s, she had Alzheimer's, she needed full-time care. He paid $9,000 a month for years to take care of his mom.
I see. A
So at that
year.
time, now people are living longer, Alex. People need money when they're alive, not just pumping money into an insurance policy, right?
Absolutely.
I believe insurance is good for the time that we need it, when we have the obligations of the family, we have debt commitments and all these things, which if you die prematurely, it would affect the family very adversely,
Yeah,
right? Yeah. So I believe we really need to zone in on the purpose of life insurance at the end of the day,
absolutely.
right?
Absolutely.
And
So can you share with us another fact, because you mentioned that premium is paying whatever amount, $300 a month. What was the investment portion of this $300 a month that she maybe can expect some decent return on her investment after, let's say, 10, 15, 20 years?
right. So let's go to I'll sort of cover that. I didn't have all the facts prepared to show the accumulation values.
Mm-hmm.
We could do that in another visit. But take a look at the investment. This is a snapshot of the policy. And you look
Mm-hmm.
at there's a chart.
Mm-hmm.
There's a chart here that shows
Yes.
that if you invest with this type of policy in the first year of your investment, Alex, can you see the rate of return in the first year?
Zero.
Um,
Zero, really zero. Come on.
okay. Now, I didn't I didn't put this together. This is a snapshot of the policy, okay?
Mm-hmm.
How about the next 5 years? You'll
Again,
earn an
nothing.
average of 1.5% per annum. So close enough to a GIC, okay?
Yes.
Um, uh, and 10 years, you probably earn about 2%. So a lot of folks that use this type of policy to invest and to maximize returns. Now, by
Mm-hmm.
the way, hey, if your main aim is not to maximize your returns on investments, that's okay. I'm not saying this is the wrong product for you. Okay. I'm not saying that. But if you're looking for a policy where you can have adequate coverage and maximize your returns, we're looking for something else, which I'll come to in a minute.
1 year, 5 years, and 10 years, and that period is pretty okay for
Okay.
persons who are willing to get the return of 2% only.
Right.
So this is the
Okay. So
last
I
I
will
heard.
Sure. Thank you. Thank you. I will repeat a part of it. So what I was saying was, I'm not saying that this policy may not be, relevant for your needs. What I was
Mhm.
trying to project was, if you're looking for a plan where you can invest and maximize your returns on your investment, it may not be the best product for you. Okay. So this is what I'm showing is for a market out there that's looking to maximize returns. Means there are other investments to do that are outside of an insurance policy, not inside an insurance policy. Okay.
So one thing, Mahendra, I would like to tackle. Sorry for interruption.
Sure.
So just to bring that to the very ground level of understanding, if your monthly premium is $300, like in this particular case, it means 3,600 a year. Whatever is investment portion of this
Yeah.
3,600 a year, in first year, your return is absolutely zero.
Yeah.
Whatever is that outcome, let's say from 3,600, maybe 60 will be invested in some kind of investments, but in the first year it's zero. In 5 years is 1.5. So that means 1.5% on $600 will be $90 return on investment in next 5 years, right?
Absolutely.
Just to
Absolutely.
make easy understanding calculations. Okay,
Yes.
move
Absolutely.
on.
And that's a great point you brought up, Alex, because a lot of folks, when they invest in a policy, they're looking at, you know what, at some point I want to take money out, right? I want to use
Mhm.
some of the funds in my policy. So now when you're ready to use the funds in your policy, you may be hit with what you call a surrender charge. So if you look at the
Mhm.
second table, table number 2, okay, there's what you
Mhm.
call a surrender charge table, where it starts out higher in the first year, but then it starts diminishing as you approach year 10. So the further you are from year 1 and the closer you are to year 10, the charge that you pay to exit and to take your investments, it lowers. So what I noticed in with these policies is in the first 10 years of the program, even though you have some money built up, Alex, you really don't want to take it out because the surrender charges are so high that you may end up owing the insurance company instead of them owing you, right? Because
Yes,
man,
I'm noticing that even in the year 10, your surrender charge percentage is 1% higher comparing return you're expecting. So it's totally insane. It's like
absolutely.
giving money on saving to the bank, and when you would like to take your money, they will charge you 1 or 2% to release your money back. This is
And
same scenario, right?
same scenario. And take a look at section 17 of the policy. It talks about the policy loans.
Mm-hmm.
Okay. Now, it clearly states that the owner may enter into a written agreement with the company's head office and request a fixed interest option loan. Usually, these loans range from anywhere 3% to 8%. Now, Alex, you know, with the current interest rate situation in our country, it may be even higher, right? So, because it's prime plus something else. So this is where people are again misguided because they once thought when they bought the policy that, hold on, I'm investing, I could take this money out. This is my money,
Yes.
right? They, most of the time, they were never explained the fact of the policy where it comes to borrowing money out of the policy. So when I say that to people, they are like, okay, what do you mean borrowing? What borrowing? This is my money, right? This is my
Mm-hmm.
money. What am I
Yeah.
borrowing? Well, read section 17 of your policy, please. Right? So this is where we actually go in and we educate that person, right? And we show them, we break down that policy because most people out there have very little understanding of what they have. Would you agree? I mean,
Absolutely.
I'm not sure how many people on this call actually read their car insurance or their home insurance policy from cover to cover, right?
I agree. My
So,
first
so
was not reading that as well. I'm straightforward. Yeah, I didn't
we're
read it.
all we're all guilty of that, I think, right? So if I wasn't educated in my field of work, I wouldn't know that, hey, if I have a life insurance policy, I need to actually open it. I need to go through the details. I need to read it, right? So some common questions I have for you out there, guys. When was the last time you heard from your advisor? If you have a policy, whether it's term insurance, whole life insurance, universal life insurance, or an investment plan of some sort, when was the last time you heard from your advisor? And
Yes, I
who
agree.
recommended him to your family? These are some of the questions I asked my client. So I thought I'll just, put it in here. And if I meet you, Alex, and you says, hey, I have $500,000 in coverage, my first question would be, well, how did you determine that you needed $500,000 in coverage?
Very good point.
Right? Most
Yes, of
people
course.
don't, most advisors don't use any diagnostic tool to determine what their client needs. It's like I come to you, you're my doctor, and you says, hey, Mahendra, you don't look too good. I'll write you up for Tylenol 3. Like, come on, you didn't diagnose me. You didn't assess anything. How can you just say, you look at me and you say, okay, I need Tylenol 3?
Yes,
It
I
doesn't
agree.
make sense. I'm not sure you would stay in that room. You probably walk away, right? So,
Of course.
so, so obviously, in these situations, we put together a plan that suits the needs of the client. So the first thing that I did, let's get to the action plan and then we'll close. The first thing
Yeah,
I did was after assessing the needs of the client, I was able to determine some goals. And one of the goals is this client needed about $2.3 million at 65 in order to retire.
I
So
see.
think about that. She needed 2.3 million based on her goals and dreams. Okay.
Mm-hmm.
So I had to customize a plan to show her that, hey, if you live long, you have X amount of dollars. If you died prematurely, on one hand, your family is okay.
Yeah, of course.
Okay. By the way, this person is now married. Okay. So they have family commitments. So here's what happened. On the left side,
Mm-hmm.
that's a little bit of a raw picture. Forgive my picture, but on the left side, I diagnosed that she needed $965,000 of life
Mm-hmm.
insurance coverage based on future commitment and also based on how much income she wanted to replace to her family.
Yes.
So right away, we established that, take a look at this. You have $500,000, but you need 965. So you have a shortfall of 465,000.
65,000. Yes,
Simple
yes,
math,
yes.
simple math. Anybody can grasp this. You need this much, you have this much, so we got to bridge the gap, right? Obviously, if you're already paying $300 a month, you don't want to think about bridging the gap because you're already paying too much money.
I agree.
So, long story short, Alex, we were able to actually put together a proper insurance plan for her. It was a 35-year level term plan, 1.14 million in coverage for only $95 per month. $95, I reiterate, per month.
Nice.
Now, with the new products that we have right now in our company, we have a new next generation life insurance product. It would actually beat that rate. If I had this product 2 years ago, would probably beat that rate by $15.
Oh, really?
Okay, pretty big deal. Pretty big deal. So here's what happened. Now, obviously, we doubled her protection. That's one. But what about her goals for retirement? What about her goals for financial independence? Take a look at this, Alex. I call it a wealth package. So, number one, we provided 1.14 million for $95. But what did we do with the rest of the money? She was paying, as you would recall, $300 per month.
Yes. Now she's
Now,
paying
Alex,
95.
now she's paying 95.
And what
So
is going with the $205 difference?
now what are we going to do with that money, right?
Mm-hmm.
There's a lot of things we can do, right? There's a lot of things, and I did a lot for her. So here's what we did, right? I showed her, listen, God forbid you passed away. Yes, we know you need 965, but we're going to deliver 1.14. But take a look at this. After investing 205 in a proper mutual fund for you, very, very prudent, well-sung mutual funds managed by our investment companies at hand, Mackenzie and AGF Investments, you would have $1.3 million just from the savings that I created for you, just from the savings. And I get fired up with this part of my presentation because here this person is actually self-insured. Now, while they're alive, they actually replace the amount of insurance they had to die for.
Yes. I agree.
So their investment statement, just imagine your investments, and this is not lottery. Okay, so I say just imagine, it's not lottery.
Yes.
But imagine your investment statement has $1.3 million, and here's your life insurance with 1.14. Now you have a difficult decision. What is it? Do I keep my life insurance? I'm already a millionaire. I have $1 million. Do I need all of this insurance? Do I reduce my insurance based on my needs? Because I'm self-insured. Now you can make that choice. But if you're the individual, Alex, if this person is someone who's going to be paying insurance for life, well, somebody else is getting rich.
Yes, of course.
It ain't your family.
Of course.
It ain't your family. So my question to people is, what life insurance company do you know that actually teaches you how to reduce the need for life insurance as time goes by?
Yeah, I agree.
See, I don't believe if I'm retired and I'm not working, let's say I stop driving, for example, I don't drive, I don't need my car. Why am I paying car insurance?
Absolutely.
I sold my home. Why am I paying home insurance?
Okay. I agree.
If I don't have the obligations that I needed life insurance for, why am I paying for life insurance? Right? So
I would like just to recap once again. So $205 a month from age 28 till retirement will build up to $1.3 million, right?
And Alex, I've only used a 9% rate of return, which I think is very prudent because if I look back at a lot of my clients with their statements, they've been investing with me for the last 10 years or last 5 years, last 3 years. We look at a track record, even during the war and even during the pandemic, their returns have been pretty good in the range of 8-9%. And in some cases, I make my disclaimer, we cannot promise, but in some cases, a little bit more, right?
You
So
know
very
what is amazing me really, and it's trembling my mind that uh, let's put everything together. If we invest in $205 a month, and actually she's not dipping in her pocket more than she was paying before by universal insurance, so everything is in the same status from
right.
financially point of view of the
Yeah.
obligations. So $205 a month, it's 2,400 a year. So you want to say you want to tell me that at the age of 28, no, really, at the age of 28, if you invest every year over year 2,500 till age of 65 with average return of 9%, that I and everybody can expect after that, how many? 35, 37 years of saving and
Yeah.
investing,
Yeah. Yeah.
$1.3 million. Are you joking or you're speaking truths?
And and you know what? The numbers don't lie. People do. And it is so true, Alex, because I've done this numerous times. I've done this in training and I looked at the numbers. It's exactly $1.32 million dollars. And the amazing part of it also is it's outside of your home. It doesn't have anything to do with you tapping into your equity in your home. You don't have to go downsize. You don't have to right size, downsize, left size. You have $1 million regardless. Dead or alive, you have $1 million. I tell people very jokingly, my goal is to make you more viable when you're alive than when you're gone, okay? So
Yeah.
let's have your family keep you around. I'm just kidding, all right? So
So I have another question now. Let's reverse the process.
yeah,
If this kind of insurance gives you $1.3 million in these 37 years, and we've seen with universal insurance in first year your return is zero, in first 5 years is 1.5, and in the 10 years from the moment of taking universal insurance is only 2%, what is in all these numbers significantly less than these term insurance we are talking about. My
right,
again
right.
question coming from the very beginning: why people are then taking universal insurance if it's obviously huge difference having universal insurance and term insurance with investment individual component?
Very good point. If I were to compare universal life insurance with just term insurance, universal life insurance may look like a more attractive product because it has an investment component and I get something back for my dollars. Make sense? Okay. Term insurance gives me nothing back. It's pure insurance. It's like your car insurance. If you don't get into
Mm-hmm.
a wreck, you don't get a benefit from it. It's like
Mm-hmm.
your home. If you didn't burn it down or you didn't get a flood, you don't get a benefit from your home insurance, right? So
Yes.
term insurance is as pure as car insurance, is as pure as home insurance because
Mm-hmm.
you're just paying for protection. Okay,
I see. Peace of mind.
peace of mind. Now, it is relatively much less costlier than universal life and than whole life insurance. That is
Mm-hmm.
why we recommend it. But it's never a good product on its own because that's just insurance. What about you?
Mm-hmm.
Insurance is not for you. Insurance is for who? Your loved ones that you're leaving behind. So
I
we're
agree.
taking care of our loved ones if we're not here because we're never going to see our insurance money get paid out.
Of course.
That would be a tricky situation, right?
Of
We're never
course.
going to be here to see that. Okay. But what we're going to be here to enjoy in this scenario is the 1.3 million. So I always believe in comparing universal life, not with term insurance. We compare it with a program for
Mm-hmm.
financial independence, which includes insurance and investments as two separate products.
I see.
It's in one program. Say, so that's the way I would look at it, and the way I would compare it. That's the way I've built my business, not comparing term with universal life or term with whole life, because term by itself you don't get anything back. But if you're
Yeah.
already, but it gives you adequate protection. But here's the thing: if you're the type of person you want to have a great retirement, then we need to look at the program. We just don't need term insurance. We need to have a program for you to have the life that you really want to have in
Mm-hmm.
20 years, 30 years from now, whatever that goal post may be, right? Does
Yeah.
that kind of clarify your question a little bit?
Yes, and I just during your sharing story, I just crunch on some numbers. So at the age of 64, your client will have $1.322 thousand dollars. So that
Yeah.
means at the age of 65, so very next year, with the average return of 9%, your client will make passive income. So keep in mind, passive income, no work, no engagement for any work, right? Peace of mind. So in that single year, at the age of 65, that client will make $118,000 a year. And when you divide with 12 months, it will give you passive income of $9,915 a month.
I
I
am so glad you brought
strongly,
that
strongly, I strongly believe that
up.
that is absolutely everybody's dream. So, Mahendra, question for the end. What we have to do to come to that $9,950 a month?
For sure, we're not working during retirement to make 9,000 a month unless we have a big business or something like that, or you have an inheritance, right?
Yes, of
And
course.
how many of us today can say we're going to receive an inheritance of a couple $1 million, right?
Of
um,
course.
so I think it's time and consistency, Alex. I think
Hmm.
having this kind of result, it takes time and it takes consistency. You have to consistently do it. When you look at $200 a month, it seems for some people it seems like, oh, it's $200 a month, it's another bill. But if we break it down to $50 a week, it's much more doable. Like
Yes.
I look at the marketing strategies of car insurance companies. They don't say $700 a month, they say 350 biweekly. So the guy
Yes.
says, I can't afford $700 a month, but I could do 350 biweekly.
Yeah. So in other words, so that means if you would like to gain this kind of financial security at that age, so you should start saving up in your early age as
Right,
soon as possible to
right.
be consistent and committed that you will be saving up, like in this case, $205. And actually, it will be taken from your account on regular monthly basis,
Right.
but you know
Right.
that these $205 will be smartly invested. You don't need to babysit that money. You don't have to
Right.
be educated
Right.
where this money will be invested for you.
Yeah.
You will have this
Yeah.
probably per average 9% return on your investment.
Yeah.
And if you build up this money in that 37 years with the power of compounding, and I believe that next time we should discuss about the rule of 72, that
Right.
will be very, very helpful to people to understand what is the power of compounding. That at the age of 64, you will end up with $1.3 million saving, what brings you very next year, the age of 65, as I mentioned, $118,000 in
Yeah.
that year, or $9,900 a month, what
Yeah.
is
Yeah.
pretty amazing and actually a buying peace of mind, right?
Absolutely. Absolutely. And first thing as we conclude here is number one, we specified who may or may not need this product. Number two, this client had a budget and she was within her budget of $300 a month. We did not overstep on her budget. The plan that we created for her did not take her a dollar over her budget. We're
Mm-hmm.
still within the means. So we're
Absolutely.
able to create all of this wealth and protect her more fully, more wholesome with the same money. So we provided more value for the same dollar. I always say to people, this is high value, low cost strategy, right? Um,
Absolutely.
and I look at to be very modest, Alex. I mean, if you have $1 million like this client going to have in retirement, and let's say they only withdraw 6% a year to
Mm-hmm.
live. I mean,
Mm-hmm.
they still have their old age security CPP. That's probably another $20,000, $30,000 combined as husband and wife. But let's say they built $1 million portfolio with us and they withdraw 6%. That's another $60,000 a year that they're living on, which means they're living off of their money At one
Yes.
point in time in life, you worked hard for your money. Now you're living off of your money because your money is working for you.
Absolutely.
And all of these assets, you don't have to get up at night and flip the TV screen and check the markets. If you want to, that's fine, if that's your thing. Well, you don't have to, because we have two professional asset management companies that manage literally billions of dollars globally that would do that stuff for you.
Excellent.
Peace of mind again. Peace of mind again. So this is how we can create a very wholesome plan, very holistic, very appropriate for the client's needs. And I always mention, we do the financial needs analysis to make sure that we provide what is suitable for the client. We assess their.
I again cannot hear you, Mahendra. Something is breaking. Sorry. It's something from your end.
Okay. How do?
Now I can.
Is it better?
Yes, I can hear you. Yeah.
Yeah, I'm sorry about that. Okay, sorry about that. So Alex, we're coming to a close here. At the end of the day, we've customized a solution for this client based on the scenario they had, and now they have better value for the same money, and it looks like it's going to be a brighter future for this household. Any questions? Any closing questions?
Yes, I have only one question. Let's say that you will stack this $1.3 million at the age of 64, and it's building up, and let's say it's in that case of your client scenario, what will happen with that money if she's not using or she partly used? What will be with that money in case of somebody will inherit that money? Anybody can inherit that money, and how it works?
Absolutely. So if it's a registered plan, like a tax-free savings or an RRSP, and there is a spouse, okay, that spouse, we would roll the funds over into that spouse's name to avoid, to mitigate any tax implications, okay? So that's what would happen. In case where there is no spouse, then those funds will be paid out to the children who are listed on the investment as the secondary beneficiaries. And in these cases where you're building wealth, I always say, have a will, have a living will, have a power of attorney for your assets and a power of attorney for healthcare as well, because you never know. You never know at what point in life you can become physically or mentally incapacitated, right?
Absolutely.
Right.
So there is again some solution. If you are not
Yes.
using these funds will be inherited by either will or will be given to your spouse. Is any
Yes.
tax implication if you don't have RSP or tax saving account?
So there are some different aspects of tax implication if there isn't a spouse that survived the other. What I will do is we will put together and we'll make this a special podcast where we'll actually look at when money flows from one partner to the other, or from the parents to the kids. What are some of the implications in terms of taxes? But there may be some tax implications which we will cover in another podcast.
Excellent.
Yeah.
All right.
And
Mahendra, thank you very much for this real case scenario and detailed explanation how it works. I'm really very impressed with the numbers, and definitely I would recommend to everybody who already has some kind of investments or universal insurance to make again additional review and overview of their insurance policies. And if you need any advice or financial need analysis, what is complementary right now from your point and your company, I really recommend to get in touch with you and to get professional advice. What is the best course of action to utilize their funds and insurances, right?
Absolutely. Absolutely. Thanks so much, Alex, for the time and for having me on once again. Looking forward to see you guys next week, Wednesday.
Thank you, Mahendra, for your time, and have an amazing day.
Thanks.
Thank
Have
you
an
for sharing
amazing
this
day.
knowledge. Bye-bye.
Thank you too.